Hey, welcome to the exchange. Let's have a look at Enphase Energy. Look at that overall valuation of the company as a whole right now based on their forward guidance. Also look at two main risks I see both in the near term and the long term. So if you're not familiar with Enphase, what they do is they make solar cell inverters, basically going from DC current to AC current that your house actually uses. They also make energy battery packs there too. So it's kind of that dual threat company, two lines of business right there. I'll pull up here is their actual financial statements. Basically everything you see left right here is the actuals. Everything you see right over here from 2022 to 2027 is kind of the forward guidance slash expectations on growth and everything else too. But I mean, as you can see, they've had strong revenue growth in 2021. That growth should maintain in 2022 and 2023. It will slow down over time and it will get pretty small, basically as the market gets a little bit saturated in the next few years or so. But again, look at the gross margin percentage down here. I mean, it's a great gross margin. Roughly 40% right now. They're saying long-term goal or long-term kind of baseline. They're saying 35%. That's why I guided it down to 35% in 2027 right there. So looking at operating expenses here, I mean, it's overall a very healthy level. Roughly 20% of revenues right now, which their long-term goal is get down to 15%. I don't know if they're actually going to get there overall, but I mean, it's still a very sustainable level looking at this. Looking at operating income here, again, roughly 20% of revenue, so dropping to the midline down there. The actual bottom line, net income-wise, I mean, they are very cash positive. This is almost a cash machine, and it should grow over time based on these projections and their guidance and everything else too. So looking at the first valuation, I did an EBITDA multiple, then at the very bottom I did a DCF valuation. EBITDA multiple, I did FY27 EBITDA, give it a 25x, which is probably a little high. It probably should be sub 20, but this is a little bit more aggressive. EV value, cash equivalents, long-term debt, etc. Dilution, I gave it 0.9% annually, which might be a little bit high, but I think, maybe more conservative on that estimate overall. But I think stock price right now is 143.49 based on these assumptions, etc. Still, I mean, it's well below what we're trading at right now. But again, a lot of things could go wrong, potentially either the margins or the growth rate here. So there are some risk factors to consider right there. Scrolling down here, it's look at actual DCF valuation here. I give it a very optimistic, basically discount rate, assuming rates will fall in the kind of medium and long term overall. So this is a pretty aggressive, I think, valuation, but it came to 121 overall. So again, it's still well below where we're trading at right now. But again, it's the same risk factors that could apply, dealing with the cash flow, with the growth rate, and the growth margins or gross margins overall. So I mentioned two main risk factors affecting this company, and this is risk factor number one right here. And this is a major one affecting them and other major solar installation companies across the board. So if you're not familiar with the Renewable Energy and Job Creation Act of 2008, what it did is it provided a 30% federal tax credit for both commercial and residential solar panel installation overall. Now this credit did reduce after December 31st, 2019. It went down to 26%. It also reduced, actually it's going to reduce again December 31st, 2022, so literally 6 months from now. It's going to be at 22% basically until December 31st, 2023. And then from there, it goes 10% for commercial installations and 0 for residential installation. So what you're having right now for the next year and a half or so is all this forward buying or forward demand for solar panels. Because if you're going to install them now, like it's really now or never, basically the next year and a half or so. Because on January 1st, 2024, if you don't start work by that point, you get no credit, there's no incentives there too. So I mean, it could be a huge demand cliff there as prices, I mean, across the board, it's going to skyrocket potentially too. So this is by far, I think, the biggest risk factor of what's going to happen potentially on January 1st, 2024, because we just don't know the answer here. I mean, it might be a small blip in demand or it could be a massive cliff. We'll just have to find out right there. So really, there's two main things that Enphase could do on January 1st, 2024. They could either drop prices and basically reduce margin, or potentially just take the overall revenue hit and have revenue drop while maintaining their margins there too. But I mean, it's going to be interesting to see what's going to happen potentially on January 1st, 2024, kind of long-term demand. Now, ideally, you want to say, hey, the market's not saturated. We're in the beginning of that S curve as it becomes more and more common to have solar panels, etc. But I mean, at a certain price point, I mean, you're priced out much of the market, and they're not going to be able to afford the actual financing of the panels themselves. But again, we'll see. We won't know until we actually have the data in early January 2020 or really 2024 timeframe. But again, this could be a massive overall headwind for the entire solar industry. So second risk factor I really see here is really the acquisition targets they're going after. And it's not that like they're bad targets or bad acquisitions, it's the price points and what they're valuing that could be a little bit inflated overall too. So I think there's 4 or 5 in total. The first one here is Clipper Creek. It's basically an EV charging solution overall. But I mean, look at the actual financials here. So net tangible assets acquired. This is actual real stuff you can see and touch overall. And they're saying right here, this is in thousands. I mean, they're saying roughly $8 million right here. Look at intangible assets here. I mean, $37 million. I mean, just massive, massive number right there. Look at goodwill. If you're not familiar with what goodwill is, basically it's a premium over the actual value of the company itself. So think of like, Elon Musk buying Twitter. He pays a premium above the actual, stock price itself. And then that basically goes down as goodwill. Basically, it's a premium of the actual acquisition target itself. But again, look at the premium. I mean, these are just massive, massive premiums on like very little actual real physical assets overall too. So this is the same company. This is on Crunchbase. Basically, it's looking at private companies overall. But I mean, look at this, $100 million deal. I mean, tiny company. They're looking at like less than 50 employees overall. So again, this is a lot of money going to a very, very small company, which again, to me, if it grows out fine, it's no big deal. But if it fails, I mean, this could be pretty disastrous. So next is a company called 365 Pronto, and it's literally the same story overall. So this is almost like an Uber for like clean tech workers overall. Again, look at tangible assets overall. This is in thousands, $38,000. I mean, look at intangible assets. I mean, just massive, massive numbers. I mean, look at the massive goodwill you have on here. So this is a $69 million deal with tangible assets of $38,000. So I mean, this is a pretty healthy valuation, I'd say, for 365 Pronto. I mean, this is one of those things where, hey, if this fails, I mean, you have to write down this goodwill on your actual balance sheet, and this can get pretty ugly pretty fast. Look at the actual Crunchbase. I mean, same thing. Tiny company overall, too, for the actual valuation itself. But again, we'll see if it works out or not, though. So DIN Engineer Services, this is an India-based consulting service. Again, looking at the same story here. Tangible assets acquired $1.2 million, intangible assets $11.7 million. If you scroll down here, actually see all that intangible assets all actually are customer relationships overall. So again, it's just a very nebulous thing. It's very hard to value that overall. And then look at that, it's goodwill $11 million here. So for this entire service, you're basically paying $24 million. I mean, it's just a pretty high valuation, but again, it might work out, but we'll see. Next one here, you actually have Sofdesk. This is one they acquired overall. So let's scroll down here to see what they actually acquired. So look, again, same story, $1.4 million in tangible assets, intangible assets, almost $10 million. And then goodwill basically takes that, doubles it up. The entire deal size is $35 million overall. Looking at the actual intangible assets themselves, I mean, they say developed technology, $6.9 million, customer relationships, $1.8 million, trade names, basically their branding is saying $500,000 right there, is basically their entire intangible assets overall too. Go to Crunchbase real fast. Again, it's the same story. It's a Canadian-based, basically installation roofing company. Again, less than 50 employees overall, pretty small company, but I mean, it's a pretty healthy valuation given them by Enphase. So what's the big so what here, and what's the big deal for all this? Well, I mean, they're being very aggressive with M&A activity right now, which is mergers and acquisitions. So my big fear is they do a massive deal. It looks like $1 billion plus deal, and they just have a crazy premium on the actual target itself. And also they're paying a massive amount, either stock or cash, to acquire a company itself. They mentioned in the earnings call they actually have deals or have targets in the pipeline right now. So we'll see what happens though. But it's definitely a risk factor to keep in mind if you're a medium or long-term investor in Enphase. Hey, but that's Enphase overall. I mean, solar is going to be here to stay no matter what. I mean, it's just too ingrained in society, and the whole green revolution, ESG, everything else too. I mean, it's going to stay. What's going to really change in the near future is really unit economics wise. Margins might shift, supply chains might shift, etc. But overall, I mean, if you're a subscriber, hey, thank you for support. I really appreciate it. If you want to be a subscriber to the exchange, hey, subscribe right now, right there. Thank you for support. Also, be sure to like and comment down below your thoughts about Enphase, risk factors, valuations, etc. But yeah, that's the exchange.